Hello traders, it's Thursday, January the 30th. This is John Kicklighter, Chief Strategist for DailyFX.com, here with your FX market wrap-up for the past 24 hours of trading, and an outlook for what we can expect in the 24 hours ahead. Now, this past session was a big hope in terms of volatility for those that are looking for medium-term swings and higher, meaning medium-term swings up to long extended trends, because we were looking for a specific piece of event risk that could potentially catalyze a long-awaited revival of meaningful drive, a common theme, whether it be monetary policy or risk trends, something with the kind of influence that could override and control the entire markets. Of course, that piece of event risk was the FOMC rate decision, and we were looking at it from both the monetary policy and the risk backdrop, and it fell apart on both accounts. Now, this is not to mean that the FOMC rate decision was a letdown. It certainly did generate some very significant change to monetary policy backdrop, especially the global perspective, as the U.S. Central Bank is the world's largest, and it will also carry its implications going forward for market activity. However, most of us finding the U.S. dollar, for example, on the very border of this rising trend channel here and forcing itself into an actual break. We did have a break before the event risk, and that is often the outcome when we see situations like this, but it didn't have follow through. The same thing can be said with other more sensitive risk assets like the S&P 500. We have come back and we have tested this very, very significant level of support. We know this to be a very meaningful technical support level because not only do we have a fib off this October to record high move, we have the 200-day moving average, we have some moderate trend line support here, but it's really long-term former resistance now treated as new support. All right, it is a combination of influence, a combination of technical support that would suggest that should we break this level, there's probably a lot of people that would be put off of their bullish intentions, meaning we probably have a round of stops placed below this floor, not too far below 1775, and there's probably a number of shorts waiting to jump in on the market once we make some significant progress. But this too, as a risk measure, has not seen a significant decline. So let's talk a little bit about the Fed decision. How did it play out? All right. Well, the scenario that was heavily expected by the markets was indeed the one that was realized. The $10 billion taper to $65 billion per month that takes place starting February 1st was the outcome that we had. All right. This was heavily expected by the markets. We're looking at the economist expectations in yesterday's strategy video. We also looked at this during the live coverage in Daily FX Plus, the live trading room. But we knew that this was the baseline expectation. And the implications, however, are still running the kind of gamut that we expect. The taper is bullish for the U.S. dollar because eventually it does promote an interest rate increase or a market-based rate increase, and it moves up the time frame for the rate hike from the Fed. All right, so that is bullish for the U.S. dollar when we're talking about relative monetary policy. It's also bullish as a return factor for the dollar. But it's also bearish for the S&P 500. We've looked at these relationships long enough that we know that there is a significant relationship between the presence of monetary policy, or as we like to call it, moral hazard, and the S&P 500. Now, it's not to mean that stimulus is pumped into the system and that stimulus turns around and buys stocks. No, that's not necessarily how it works. But there is a very strong connection between the two. All right? Stimulus actually leverages our expectations for risk in general for the market. So here we have the total stimulus level of not just the Fed, but we include here the Chinese Central Bank, the People's Bank of China, the Bank of Japan, the European Central Bank, the Bank of England, the Swiss National Bank. All right? All those major central banks are included and incorporated into this total stimulus level. Now, I flipped the VIX, or volatility index, upside down to give you a one-to-one relationship. But this is typically what the volatility measure looks like. As we see this stimulus rise, fear declines. Investors think that the same kind of massive stimulus program that was introduced during the height of the financial crisis in 2008 and 2009 is always a possibility as the stimulus rises. And that, in turn, could lead to the kind of positive bearing on the capital markets and the inflow of capital that we had seen back then. However, there is a question as to how consistent we can be with that kind of stimulus, how effective it is at the margin when we see it continue to rise, and what happens ultimately when it starts to level off and starts to be withdrawn, considering that we are at record highs on U.S. equity markets. So, this relationship between expected fear or volatility and the level of stimulus is a good one, and thereby we make that connection, we pass it over to the S&P 500. So that's how that relationship works. So inevitably, this is a outcome that is not conducive to risk-taking. All right. We add to the fact that the ECB has been slow to present us with some level of open-ended stimulus or LTRO-like program that would help inject some liquidity back into the system, because their balance sheet has been contracting and their stimulus amount has been contracting. We see the Bank of England is being speculated upon for a rate hike sometime this year, according to what we see in yields in the pound and swaps. And the Bank of Japan, who has up until this year been very vocal about its need for an upgrade to the stimulus program, has backed off a little bit. All right, so not only are we seeing the Fed taper, we're seeing the other central banks are not moving in to fill that void. This is very discouraging from a general sense of risk trends. All right, but what really matters to us is where the next move happens. If we do hold risk into the end of this week, there are opportunities available to us. It's almost certain. There are a number of setups that we can look towards, and actually one of my favorites, the only one I held into the actual rate decision itself, is actually one that can continue to cater to this. We can also look at trades that don't have their connections to risk, and we'll look at a couple of those in just a second. But I do want to be prepared for a risk aversion scenario. All right. If we do have risk aversion, what would be the catalysts? Well, that was the topic of today's strategy video. I recommend that you look to that. But just to give you a quick overview, the taper itself as an interest to the broader capital markets has significantly deteriorated, right? Especially since the December 18th first taper move. And we can see that this is going to have a reduced impact on market activity, at least in short-term volatility terms. Over the medium to long term, you will see that we will revisit this, and investors will start to think, oh no, the stimulus backdrop is cooling off, and this is going to be a concern going forward. But for immediate volatility purposes, this is not necessarily an immediate concern. We also see that the concern about just broader financial stability is not yet at peak levels. We can see that the term, or the search term for a crisis, has indeed picked up, but it's not the level where this is immediately in front of people's minds, and subsequently they're going to be very sensitive and react to these kind of concerns, so that whether it be media hype, whether it be a particular market development, or whether it be a piece of event risk. All right, this is not something that we are not necessarily going to see ignite a level of panic in the market. But what we are still seeing influence the markets is emerging markets. All right, emerging market concerns have been very readily influential, and we've seen that they have led to some substantial volatility as of late. In fact, you can see these recent swings in the capital markets, the S&P 500, have lined up nicely to the pullbacks in the S&P 500. So when we flip it upside down, in other words, as concern about the emerging market picks up, that seems to be a catalyst for the S&P 500. So emerging markets have been a concern for the broader capital markets for some time. Now the question is if we can get this to be market enough. Enough momentum in the capital flows out of the emerging markets to spill over to the broader financial sector and to infect the S&P 500. So what do we look for the emerging markets? What are we going to keep our eyes on? Well, you can look at the emerging market ETFs. This is actually the MSCI emerging market ETF. It's actually the largest ETF for emerging markets. You can see the volume has also spiked this past session. The highest level of volume for the ETF since June. And before that, we were back in serious volatility conditions for the FX market, the capital markets, the international financial markets. All right. So this is certainly a sign, an indication that we still have these levels of volatility out there. Now, we've also been talking a lot about the dollar, Argentine peso. We've also been talking about the Turkish lira, though we won't talk about the Turkish lira. But there are many other emerging market currencies we can take track of. Now, one of the ones that I think has been very sensitive and has been less covered is the dollar ZAR, or the U.S. dollar South African rand. You can see that we have definitely driven to exceptional heights. It's not a record high. We actually have a peak here back in 2008 that's much higher. But you can see that consistent push in this past session was a big rise. You can look at others too. The dollar and Mexican peso, all right? The real, the ruble, all right? All these are currencies that are in the emerging market sector. And it's actually better to look at these more robust, more traded currencies, especially amongst the BRICS, right, which are the major developing country currencies, because it suggests that we are moving up in scale. Now, remember when I was talking about the scale of risk trends, when risk appetite, or sorry, risk aversion increases and fear increases, its impact on the market rises. Right, so we have this relationship here. We are probably somewhere around here on the market, on this curve right now. Now, if we can look at the assets and their sensitivity or resilience to risk trends, as risk aversion rises, the more resilient asset classes start to respond. You can see here actually the euro dollar is at the very extreme end of this, but so too are the quote-unquote risk-free assets, the treasuries and all that. But we can see that there is a variable degree as we rise up this curve. Now, the emerging markets are some of the most sensitive. But even within this category, we can see that there will be a sign of the risk theme moving up the scale. And that would be seeing it move not just on the dollar Argentine peso exchange rate, but seeing that volatility also spread to the broader emerging market set that includes the South African rand, the Brazilian real, all right, and the Mexican peso, all those other currencies as well. Once we see if this entire sector is moving as a unit, that's when we have the market truly responding to a risk-based theme. All right, so we'll be keeping a very close eye on this. This is going to be important through the upcoming 48 hours, and it can still give us enough of an uncertainty and provide enough of a push to potentially move up the scale to general risk aversion. All right, we are so close to this support, and if risk aversion were to kick in, the options would be many. They'd be varied. Of course, we can always look at pairs like Aussie dollar and pound dollar and euro dollar, but realistically speaking, the euro dollar and pound dollar influences by the risk trends, or the sensitivity to risk trends, is dampened, deadened. So they're not necessarily going to move very easily. So if you want to see this move on risk aversion, you need to see serious risk aversion. Now, both of these pairs can still move on their relative monetary policy outlook, and in fact, I think that they both support euro dollar and pound dollar to the downside, but it's not necessarily a trade-worthy event, because timing is imperative. All right, it's been said many times before, and it will be said many times in the future, that you can be right at the wrong time and you're wrong. All right, you have to time these things properly. So knowing that the fundamentals do lean one way does not necessarily make it an active trade. But risk aversion would certainly be a sensitive measure here in the yen crosses. We did see a very significant pullback with the emerging markets conditions, and we had a very sharp pullback through the morning session on Wednesday. This would also spill over to the euro-yen, pulling us back below that head and shoulders neckline, which I can't call that a neckline anymore, this dotted line. We need to see something that truly clears this congestion, and that's not going to be it anymore. Pound-yen, similar circumstance. Really the most remarkable developments, however, came on the behalf of the Kiwi-yen and the Aussie-yen. All right, those were perfect technical holds and reversals, big swings. I know a couple of you took advantage of it. Good trade. There was some risk taking it into the FOMC rate decision, but you came out on the right side. The Kiwi yen, as you can see here, was more aggressive. All right, why is that? is because when we had a secondary fundamental driver that we could cater to the volatility here. Now, as we were talking about yesterday, there was two rate decisions back to back, the FOMC decision and the RBNZ decision. Now, the FOMC decision was exactly in line with expectations, but it was the RBNZ rate decision which generated a little bit more remarkable volatility from the backdrop. All right. Markets, though they were expecting a hold through the period, there was a 35% probability, according to swaps, from the market that they were expecting a rate hike of 25 basis points. So that means that there was a 35%, the people that were priced in at 35% probability were on the wrong side of the market. They were expecting too much and they didn't get it. All right. So subsequently, the Kiwi would have some level of selling pressure on that update. Well, we indeed get the selling pressure, and the New Zealand dollar drops off. Now, against the Kiwi yen, where the risk sensitivity has pulled back, you add something like a New Zealand dollar selling pressure itself, and though these are both mild themes, relatively speaking, you have a more significant pullback. All right. Now, other Kiwi-based pairs were a little bit more restrained. Aussie Kiwi did rise, and you can see here on the daily chart we are up for a fifth consecutive session now. We are almost going to break this rising trend line. If you recall, in the 2014 Trading Opportunities report article from Daily FX, one of my favorite trades is the Aussie Kiwi to the upside when it does make its turn. We're getting pretty darn close. So I'm going to keep a close eye on this one. This is another interesting Kiwi-based pair. But I think that falling outside of the spectrum of risk, the pound Kiwi actually is perhaps one of my more favored setups that has yet to fulfill or to set up yet or trigger. And you can see, we've been talking about this a few times, that we have three large technical patterns here. One, we have the triple top. Two, we have a rising wedge. And three, much larger, we have this big decline and then what looks like an inverse head and shoulders pattern. All right, so this is three nested technical levels. Now, with the pound and the Kiwi, we're talking about two competitive yield forecasts from these two currencies. The problem is the market has overrun its expectations on the British pound. Is a rate hike in 2014 really going to be that remarkable? Can it really drive the pound significantly higher against the New Zealand dollar? Because with the New Zealand dollar, we're talking about multiple rate hikes in 2014 and a consistency thereafter. All right, that's where the speculation currently lies. So this is a long-term and a medium-term fundamental play, but you also have shorter-term implications. The hold on the New Zealand dollar is one factor that we have to take into consideration, but we can play to the technical patterns as well, considering that everything is relatively status quo. This is going to be one that I'm going to watch, whether I want to get bold and try to take it at the top of the triple top, or whether I'm going to wait for a break down here below 199.50. We'll have to see, but this has some interesting technical bearings, and it has a certain level of fundamental immunity, though it's not something that I would be considering completely risk-free. Now, in terms of a fundamental event risk, we've had a very busy past 24 hours. Well, guess what? It's not going to get much easier. The docket is filling out once again. We have some very noteworthy European data, good for short-term volatility as well as some fundamental rumination on our part. The Spanish GDP, we're going to see how the periphery is doing first. All right, this is very worthwhile. Watch that data. We'll watch the German employment figure. This is always good for volatility when it misses and deviates from expectations. And we have the confidence figures. All very worthwhile data. And you can even throw in, I guess, the German CPI in there to give us a broader sense of inflation in the region and where Germany goes, oftentimes monetary policy goes. But we also have Chinese manufacturing update from the HSBC. We have the US GDP figure. That is a big back-to-back release. FOMC decision, US GDP. And then, of course, we get into Thursday night, Friday morning, Japanese CPI. We're going to talk about that stimulus program once again. We'll wait until tomorrow before we start talking about the yen crosses and stimulus expectations from the Bank of Japan, but keeping a very close eye on dollar yen and euro yen and pound yen and all those other yen crosses between that relative monetary policy effort and risk expectations is going to be a very big thing into the final 24 or 36 hours of this trading week. All right, so keep your eyes peeled. The most immediate concern that we should have is how significant risk trends become, because we are on the cusp of some very big moves in the more liquid and more steady markets that speculators populate. And that's not just the S&P 500. Here we have the Nikkei 225 major trend line. We have it on the European equities as well when we look at the FTSE 100 major trend line support. All right, so it's essentially everywhere. But we need to see it move up that scale. We need to see it evolve out of the emerging markets and get into those more liquid, those more populated asset classes. All right. So keep vigilance and have your trade setups ready. Have risk on, have risk off, and risk neutral trades at hand, and you'll do a lot better. Good luck trading out there, guys, and I'll update you once again on these markets tomorrow.